The word recession keeps floating around again, and it's not subtle anymore. Prices haven't really cooled in the way people hoped. The market feels unpredictable. Job security doesn't feel as solid as it once did. And every time financial news pops up, that same word shows up like an unwanted guest that refuses to leave. Recession. Maybe it happens. Maybe it doesn't. But here's the uncomfortable truth that rarely gets said clearly enough. The people who come out of economic downturns in a strong position are not necessarily the ones who earn the most. They are the ones who prepared before things got messy. And most people don't. Not because they can't, but because preparation doesn't feel urgent until it suddenly is. By the time headlines officially confirm a recession, the damage is already in motion. Layoffs have already started, markets have already reacted, and people who didn't prepare are already scrambling to catch up. So instead of reacting late, this is about moving early, calmly, strategically, without panic. This is the Recession Playbook. 7 moves, not complicated, not flashy, but powerful enough to completely change how the next economic downturn feels. Move 1. Define the number that keeps everything together. Before any strategy, before any investing, before any budgeting hacks, there's one number that quietly controls everything. And surprisingly, most people have never actually calculated it. That number is the bare minimum cost of staying afloat each month, not the current lifestyle. Not the upgraded version of life with subscriptions, takeout, and extras layered in. Just the absolute baseline required to keep life functioning. Think rent or mortgage, utilities, groceries, insurance, minimum debt payments. That's it. No fluff, no comfort spending, just survival. When that number gets written down, something shifts immediately. It removes guesswork. It replaces vague financial anxiety with something concrete. Now here's where it becomes powerful. Take that number and multiply it by 6. That's the target. That's the safety net that turns a job loss from a crisis into a situation that can actually be handled. Because without that buffer, everything becomes reactive. Decisions get rushed. Investments get sold at the worst possible time. Stress takes over logic, and that's exactly how financial damage compounds during recessions. But with that buffer in place, something else happens. Time appears. Time to look for the right opportunity instead of the first one available. Time to avoid selling assets when markets are down. Time to think clearly instead of acting out of fear. And time is one of the most valuable financial assets during uncertainty. Most people skip this step entirely and jump straight into investing strategies or market predictions. That's backwards, because no investment plan survives if there isn't enough liquidity to cover basic life when income gets disrupted. The foundation isn't built with stocks or returns, it's built with stability. And stability starts with knowing exactly what it costs to stay in the game. Move 2. Take a hard look at income stability. Income feels steady until it isn't. And that's where a lot of people get caught off guard. Not all jobs behave the same way during economic downturns. Some industries hold up relatively well. Others get hit fast and hard. Sectors tied to essentials, like healthcare, utilities, and certain government roles, tend to remain more stable. Meanwhile, areas tied to discretionary spending, like hospitality, retail, marketing, and construction, often feel pressure much earlier. But the industry alone doesn't tell the full story. There's a deeper question that rarely gets asked, but it matters more than most financial metrics. If a company had to cut 10% of its workforce tomorrow, where would that position fall? Near the top of the list or closer to the bottom? That's not about pessimism, it's about awareness. Because preparation isn't about assuming the worst, it's about understanding the current position clearly enough to act intelligently if things shift. Another angle that deserves attention is replacement time. If that income disappeared, how long would it realistically take to replace it? A few weeks? A few months? Longer? That answer changes how aggressively preparation needs to happen right now. The labor market has already started showing subtle signs of softening, with hiring slowing compared to previous years. That doesn't mean collapse, but it does mean competition can increase quickly if conditions tighten. And when more people start chasing fewer opportunities, time becomes even more valuable. This step isn't about fear, it's about clarity. Because when income risk is understood early, it becomes easier to make smarter decisions before those decisions feel urgent. Move 3. Stop funding things that don't protect the future. Not all spending is equal. That sounds obvious, but most budgets don't reflect that reality. Some expenses actively support stability. Others quietly drain resources without offering anything meaningful in return, especially during uncertain times. The key here isn't extreme restriction, it's redirection. There's no need to eliminate everything enjoyable or live in constant deprivation. That approach usually doesn't last anyway. Instead, the focus shifts to identifying spending that doesn't actually serve a purpose beyond short-term convenience. Subscriptions that barely get used, services that run automatically in the background, small recurring charges that seem harmless individually but add up quickly over time. When looking at the past few months of spending, patterns start to appear, and those patterns tell a story about where money is going and whether it's helping or hurting long-term stability. Even a few $100s per month redirected into savings can significantly accelerate progress toward a financial buffer. And here's the important part. That money doesn't just sit idle. Placed in a high-yield savings account, it can generate returns while remaining accessible. It's not about maximizing profit. It's about maximizing flexibility. Because flexibility becomes incredibly valuable when uncertainty increases. There's also another layer to this: large variable expenses. Food, dining, entertainment. These areas often offer opportunities to adjust without dramatically impacting quality of life. Small changes, applied consistently, can create noticeable breathing room. And that breathing room matters more than most people realize. Because during a recession, the goal isn't just to survive, it's to avoid being forced into bad decisions. And unnecessary spending is one of the easiest pressures to reduce before things get tight. Move 4. Deal with high-interest debt before it becomes a trap. Debt behaves very differently when the economy is strong compared to when it weakens. When income is stable, high-interest debt feels manageable. Payments get made. Balances slowly decrease. It stays in the background. But during a downturn, that same debt can quickly turn into a serious problem. Because unlike income, debt obligations don't adjust. Payments are still due. Interest continues to accumulate, and flexibility disappears. That's why high-interest debt, especially anything above 10%, becomes one of the most dangerous financial positions to carry into a recession. Credit cards, personal loans, high-rate balances. These aren't just numbers. They're ongoing commitments that demand cash flow every single month. And when income becomes uncertain, those commitments don't pause, they tighten. That's where the trap forms, because instead of having options, money starts getting locked into obligations that can't be avoided. The solution isn't complicated, but it requires focus. Prioritize the highest interest rates first. Keep minimum payments on everything else, but direct extra cash toward the most expensive debt. That approach reduces the fastest growing problem first, and the impact can be significant. Even modest additional payments can shorten timelines and reduce total interest dramatically. But beyond the math, there's a deeper benefit. Each eliminated payment creates more breathing room, less pressure, more flexibility. And during uncertain economic periods, flexibility isn't just helpful, it's protective. Move 5. Keep investing, but remove complexity. When uncertainty increases, the natural instinct is to pull back. Stop investing. Wait for clarity. Avoid risk. That reaction feels safe in the moment, but historically it's been costly because markets don't wait for comfort. By the time conditions feel stable again, a large portion of the recovery has often already happened, and missing that window can have long-term consequences. The key isn't to stop investing, it's to simplify. Complex portfolios filled with individual stocks or speculative assets can become harder to manage during volatile periods. They require attention, decision-making, and emotional discipline, all of which become more difficult when uncertainty rises. Simplification reduces that pressure. Broad index funds, diversified exposure, low-cost structures. These aren't exciting, but they are resilient. And resilience matters more than excitement during economic downturns. Automation also plays a crucial role here. Consistent contributions, regardless of headlines, remove the need to time decisions. They allow participation during both declines and recoveries, and that consistency often leads to stronger long-term outcomes. Because downturns don't just bring risk, they also bring opportunity. Lower prices, better entry points, long-term growth potential, but only for those who remain in the market. The goal isn't to predict the future, it's to stay positioned for it. Move 6. Build psychological stability. Before the headlines hit, financial preparation gets most of the attention, but there's another layer that quietly determines how decisions actually play out when things get difficult, and that layer is psychological. Because recessions are not just numbers on charts or percentages in reports, they are lived experiences. They show up as stress, uncertainty, and constant exposure to negative headlines that make everything feel more urgent than it actually is. And in that environment, the biggest risk is not always a lack of money, but a lack of clarity. When there's no plan, every new piece of information feels like a threat. Every market drop feels personal. Every headline feels like a signal to act immediately. That's when people make decisions they wouldn't normally make, selling investments at the bottom, freezing contributions, or making sudden changes based purely on fear instead of logic. Preparation changes that entire experience. When the survival number is already calculated, when there's a cash buffer in place, when debt is under control, and when investments are structured in a simple, automated way, something shifts internally. The same headlines still appear. The same economic data still gets released. But instead of triggering panic, it becomes information. Something to observe, not something that dictates behavior. That difference is subtle, but it's powerful. Because staying calm during uncertainty isn't about personality. It's about preparation. And the people who appear calm during downturns are usually not guessing or hoping. They've already done the work ahead of time. They know where they stand. They know what their plan is. And that clarity allows them to move deliberately while others are reacting emotionally. Economic uncertainty doesn't remove options. It exposes whether options were built in advance. And psychological stability is often the result of those earlier decisions, not something that magically appears in the middle of chaos. Move 7. Accept uncertainty, but remove unpreparedness. There's always a desire to know exactly what's coming next, whether the economy will contract, whether markets will fall further, whether job losses will increase. But the reality is that certainty rarely shows up in advance. Even now, the outlook isn't a clear collapse. It's mixed. Some indicators suggest resilience, like consumer spending holding steady and corporate balance sheets remaining relatively strong. Others point toward vulnerability, like elevated costs, global disruptions, and a labor market that is starting to soften. That combination creates a situation where outcomes can shift quickly and forecasts become less reliable. And that's exactly why preparation matters more than prediction, because predictions don't protect against uncertainty. Preparation does. Waiting for a confirmed recession before taking action is one of the most common and costly mistakes. By the time official data confirms a downturn, the most important opportunities to prepare have already passed. Prices have adjusted. Hiring has slowed. Financial pressure has already begun building. Preparation works best when it feels early, even unnecessary. That's usually the window where the most effective moves can be made without stress or urgency. And the goal isn't to eliminate uncertainty. That's not possible. The goal is to remove the consequences of being unprepared. When there's a financial buffer, when spending is under control, when debt is manageable, and when investments are structured for the long term, uncertainty stops being something that disrupts everything. It becomes something that can be navigated. That's the difference between reacting and responding. And that difference is what separates people who struggle during downturns from those who remain stable and even find opportunities within them. Bringing the playbook together. At this point, the full picture starts to come into focus, and it's not complicated, but it does require intention. Everything begins with understanding the true cost of maintaining life at its most basic level, and building a financial buffer that can support that cost for several months. That single step creates space, and space changes how every other decision gets made. From there, income stability becomes something to evaluate honestly, not something to assume. Knowing how exposed a situation is before conditions change allows for adjustments while there's still time to make them comfortably. Spending then gets filtered through a different lens, where the focus shifts away from convenience and toward function. Money stops drifting into areas that don't provide long-term value and starts getting redirected into areas that create resilience. Debt gets addressed not just as a financial obligation, but as a potential risk that can grow under pressure if left unmanaged. And removing that risk ahead of time reduces the number of fixed commitments that need to be maintained if income becomes uncertain. Investing continues, but without unnecessary complexity. The focus moves toward consistency, diversification, and long-term positioning rather than short-term reactions. And finally, the mental side of all of this comes together, creating a sense of clarity that allows decisions to remain grounded even when external conditions feel unstable. None of these steps rely on predicting exactly what will happen next. They don't require perfect timing or advanced strategies. They simply build a structure that can handle multiple outcomes. Whether the economy slows gradually or experiences a sharper downturn, the same preparation continues to provide value. The reality most people miss. There's a common assumption that financial success during difficult economic periods comes from making the right moves at exactly the right time. But more often than not, it comes from avoiding the wrong moves during the worst moments, selling under pressure, taking on more debt to compensate for reduced income, ignoring early warning signs because everything still feels manageable. These are the decisions that create long-term damage, and they usually happen when there's no preparation in place. On the other hand, people who have already built a buffer, reduced unnecessary expenses, managed their debt, and simplified their investments are not forced into those situations. They don't need to make desperate decisions because they're not operating from a position of urgency. That difference doesn't always look dramatic from the outside, but over time, it creates completely different outcomes. One path leads to recovery and growth after the downturn passes. The other leads to prolonged financial strain that can take years to fully unwind. And the dividing line between those paths is rarely income or luck. It's preparation. A recession might happen, or it might not. The signals are mixed, and the future isn't guaranteed to follow a single path. But waiting for certainty before taking action is one of the riskiest approaches possible, because by the time certainty arrives, flexibility is already limited. The smarter approach is to act while conditions are still manageable, while there's still room to adjust, and while decisions can be made without pressure. The playbook is straightforward when broken down. Know the minimum cost of living and build a buffer around it. Understand income stability and how quickly it could change. Reduce spending that doesn't contribute to long-term security. Eliminate high-interest debt before it becomes restrictive. Continue investing in a simplified, consistent way. Strengthen the mental side of financial decision-making, and accept uncertainty without allowing it to turn into unpreparedness. These are not extreme actions. They are measured, practical adjustments that create stability in an unstable environment. And the earlier they are implemented, the more effective they become. Because when conditions eventually shift, whether gradually or suddenly, the groundwork has already been laid. And instead of reacting under pressure, there's the ability to move forward with clarity. If this breakdown brought clarity and helped make sense of what to actually do before things shift, consider subscribing and staying connected for more practical, no-noise financial strategies that focus on preparation, not panic.